Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today. In the previous segment, we were talking a little bit about taxation, kind of the broad concept of taxation in America and how to earn your income, different ways that you can be taxed. And we finished up talking the most favorable taxation is dividends and capital gains, which are taxed at a maximum of 15%. I just thought I'd spend a minute talking about this concept of carried interest, which Mitt Romney makes a lot of his money from what's called the carried interest, where a private equity firm takes in money from investors and goes out and buys other companies. And part of the income that the private equity firm makes is treated as capital gains income instead of ordinary income. And that's where a lot of sort of the firestorm over this debate comes in. Mr. Romney, Mr. Buffett, these people that earn these types of income, they're not doing anything wrong. They're just taking advantage of the tax code as it's written. And I think that any real reform on this, if they nibble around the edges and do away with carried interest, there'll always be these exceptions. The only way to completely eliminate this is to go to some sort of flat tax or some sort of consumption tax. Otherwise, Congress people are always going to come up with some sort of loophole or some sort of exception for their little special interest group, and we're going to continue to have these problems. Today it's the carried interest. Tomorrow it will be something else. I remember back in the 80s, all the high-earning people were investing in these limited partnerships. They had these big loopholes. And by the way, I can't stand the word loopholes. The fact of the matter is the majority of them are written right into the tax code, and that nobody's taken advantage of it at all. That's just the rules. So anyway, keep that in mind when you're out there earning your money. You want to try to get some capital gains and dividend income as well as some passive income if you're looking to lower your overall tax rate. Okay, I thought I'd finish this segment up with a little bit of talk about investment performance. This is the year 2012, hopefully you know that. And if you recall, March of 2009 was the end of the bear market from 2008. And what's going to happen, you're going to see somewhere around March, you're going to see a lot of mutual fund companies, a lot of money management companies and the like. They're going to start touting their 3-year returns. That performance ending from 3/31/2009 to 3/31/2012, a lot of these are going to look pretty good. They're going to get rid of the first quarter of 2009 was abysmal. And I'm kind of giving you fair warning because you're going to see some tremendous marketing coming out of Wall Street around April. Once the first quarter of 2009 drops off the 3-year investment horizon, you're going to see advertisements everywhere for this fund's 3-year performance and this money manager's 3-year performance. And so I just wanted to kind of let you aware of that. There's a guy named Mark Hulbert, and he publishes the Hulbert Digest, I think it is, and he tracks the investment performance of mostly newsletters. People that write a newsletter, whatever system they follow about buying and selling stocks or bonds or something like that. And he's been doing this for like 30 years or so. And one of the things that he always cautions against is if you ever see these really high performance returns, more than likely either the person is just completely making it up or they have selectively picked the time frame out that they want you to look at. And I think that you're going to see a lot of that as we continue on to 2012, is that people are going to start cherry picking, as I say, their performance. And so you should always ask for their performance since they began, and don't let them just show the 3 years that they want to pick out. The other thing that you want to look at is making sure that they have a longer track record than 3 years when evaluating on performance. Of course, we like to think if you are looking at a newsletter or something like that, that's all you have to go on. If you're looking at an advisor, whether it's us or someone else that has a comprehensive investment program, the way the investments are handled for each client is so differently. You're not going to see the same type of performance reporting that you can do with, say, a mutual fund or something like that. So I'm talking here today about these investment newsletters, the thing you see, advertised, look at our great performance type things. The second thing, and I see this all the time, there's a very large money manager out of Chapel Hill who will remain nameless for now that manages several $billion. And when you report your performance, you form these composites. And what a composite is the clients that all have the exact same objective, and you keep track of their performance, and that's what you report on. And so this particular firm, and you got to read way down in the fine print to figure this out, but someone brought this into me one time. They said, oh, look at this great performance that this money manager has up in Chapel Hill. And I did a little bit of research, and they manage billions and billions of dollars. And on the performance thing that they gave this person, down at the bottom it said, this composite is based on accounts with a net value of $12 million. I said, $12 million? I mean, that's not even a fraction of the money that they manage. And so it's very deceptive. Essentially they took one account and they formed a composite, and that was the composite that they decided to report on, and they disclosed it, and so it's perfectly acceptable for them to do that. So that's the second thing I want you to look out for, is when you have these mutual funds or money management firms and they form these composites, that that it's representative of all the accounts that they manage. Once again, with a wealth management firm like myself or others, because the clients are so diverse and their portfolios are custom tailored, you're not going to see that type of performance reporting. And in fact, it really doesn't make much sense if someone is putting money in or taking money out of the portfolio. It's very hard to aggregate it. And so, in defense of some of these firms, my opinion is they shouldn't even bother, but they do, because it's very difficult to take a client. If you have a client and he puts in $1 million one day and takes out $250,000, and the manager has no control over that, and it's very difficult to manage that process, but yet it affects the rates of return. So anyway, that's about all the time we have for this segment. Once again, just want you to be aware that come the end of March and April, I think that Wall Street is really going to crank up the marketing machine as the bad numbers of the bear market fall away. And we just want you to be aware of, don't fall prey to this aggressive marketing that's probably going to come out. Make sure that you look at the full track records and make sure that these funds or managers are reporting all the assets. So for All Things Money, I'm your host, David Blain. Thank you for joining us, and we'll see you again at the same time next week.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.